Good afternoon and welcome to the Affluence Investment Trust webinar. I'm Darryl Wilson.
I'm Greg Lander.
And we're going to go through today our newest fund, the Affluence Income Trust. We're going to talk to you a little bit about how we created the fund, why we created it, what's in the portfolio, what we like about it, and hopefully answer most of your questions along the way. First off, I think it's important to know this is the missing piece of the puzzle for us in terms of our fund suite. It is purely focused on fixed income and on income, as opposed to a mixture of income and capital growth like our other funds. It is our lowest risk fund, which means that the unit price is designed to be relatively stable and the income designed to be relatively regular. And if we compare that perhaps to our other funds, our Affluence Investment Fund is our kind of complete done-for-you solution, medium risk, a mix of income and some capital growth, and importantly includes an allocation to all of our other funds, plus about 30 or 40 externally managed funds and other investments. And then our Affluence LIC Fund is more of an equity-focused product, very specific product designed to be able to take advantage of the returns from listed investment companies, including us capturing some of the discounts that are available, and there's some very good buying right there at the moment. And our small companies fund is, as it sounds, specifically directed at the small cap space. It's a higher reward, higher return, higher risk product for wholesale investors only. So back to the Affluence Income Trust. Why are we doing this? Why now? Well, firstly, the focus of this fund is on the fixed income space. The fixed income space, essentially, if you're new to it, is really investing in debt instruments, loans, bonds, those sorts of things. So what you're really owning is a bunch of assets where there's an underlying borrower who pays interest for an agreed term and then hopefully repays the loan at the end of that. We are investing principally through a range of other funds run by some exceptionally good external managers, and we'll talk more a little bit about that as we get into the portfolio. Now, when you look at fixed income, there's really two parts to the returns you get from the fixed income. There's what we call the base rate and the margin. And I think it's important to talk about those two separately to kind of understand why we arrived where we have. So in terms of the margin or the risk premium that you get for investing in fixed income, what's been happening over the last 20, 30, 40 years is that Australia's banks have been gradually lending to less and less different types of borrowers. They now almost exclusively focus on mortgage loans, incredibly low-risk mortgage loans, and incredibly low-risk business and property loans. And everything else has really been outsourced to other managers. Now, this is a trend that's been going on, as I said, for a long time, but it's probably accelerated in the last 6 or 8 years, particularly since the local regulator and worldwide regulators implemented what's called the Basel III regulations. And what that essentially has meant is that banks are now penalised for going outside the norm, outside the most secure and least risky loans, and they're penalised by having to allocate more capital from their balance sheet to those sorts of loans. What that's meant is it's just not economic anymore for banks to do it, and so they've effectively stopped doing it. Taking their place is a whole raft of very, very good quality managers who've gone out and started lending in the bank's place. And they lend to private investors, listed companies, by and large, a very high quality borrower set, and they've taken on a lot of that market share. They've been backed by large institutional investors, large Australian super funds, wealthy family offices, and other investors who can see that there's very good margins, very good returns available for not a lot of extra risk. The other thing that's changed most notably, obviously in the last 18 months, is interest rates have come up quite a bit. And that's really what had held us back launching this fund before now, because for almost the entire period, Affluence has been running managed funds since 2014, 2015. You'll see the RBA Reserve Bank rate has been really at 2% or below. And at that rate, the returns you can get are less attractive. They're probably 5%, 5.5%. Whereas now we can deliver returns of obviously 7 to 8, or perhaps even a bit more if we see interest rates increase. So for the first time in 7 or 8 years, we've seen an opportunity to put a fund out there that gives a decent return and also a decent premium above what you can get perhaps from a term deposit or cash in the bank. The objectives of this fund, there's really 3 of them. Firstly, we start with a highly diversified portfolio, and that's one of the things that sets this fund apart. The portfolio, as you'll see as we go through, is very, very diversified. We're also focused on capital preservation, which means that we'd like the unit price to be fairly stable. We'd like to preserve capital over periods of 3 years and longer, but also we wouldn't expect too much fluctuation in unit price from month to month, which means we can focus solely on putting together a portfolio that gives investors the best risk-adjusted returns we can and paying those out in the form of monthly distributions. In terms of that distribution target, we're looking to deliver the cash rate plus 3% premium. So at the moment, that's equivalent to 7.35%. And interestingly, we've chosen that because you'll see the cash rate roughly has approximated what's available from term deposits at the moment. This is RBA data. You can see they publish it every month. So as an example, and you might want to benchmark yourself against others out there, for all of Australia's households as at December 2023, at call money was paying 2.6% on average. All outstanding deposits, including term deposits, 3.1%. Just term deposits, 4.5%, and probably for the first time in almost 2 years, as at December 23, the rate for new term deposits is below the average for existing term deposits. And that again is because we've gone from perhaps expecting more interest rate increases from the Reserve Bank to now perhaps expecting that the next move will be a cut. And so banks have scaled back the attractiveness of their term deposit products. What we're trying to do with this product is really mimic something close to what you might get from these, plus that premium. So the distribution will move perhaps up and down over time as that cash rate changes, hopefully with a bit of a lag depending on how we construct the portfolio from time to time. We've been running this fund since July, August 2023. We set the fund up in July and we started investing in August. You can see here, so it's only really 6 months results, but you can see so far, we're pretty happy with the results. We've managed to deliver returns that are slightly above our benchmark. Current distribution rate of 7.5% per annum. That's net monthly distributions after all fees and costs are taken into account. And the total return since inception is about 8. So we've been able to glean a tiny bit of increase in unit price over and above what's been paid out in distributions. Importantly, fairly consistent month to month in terms of the distribution rate at sort of 0.6 to 0.7% per annum. Now, the other important thing about this fund is we have the ability to go to a wide range of places within the fixed income sphere. And this is quite rare within the space and it's quite unique. So normally fixed income funds are very much focused on a small niche. It might be private credit, it might be government bonds, it might be high yield bonds. And that's great, but it also means that those different sectors will outperform at different times in the cycle. By allowing ourselves the opportunity to invest across the entire fixed income spectrum, we can change the portfolio over time as market conditions change. And we can position, at any given time, we can be positioned in the areas we feel give us the best risk-adjusted returns, and that will change through the cycle. At the moment, we're really targeting what we see as the core funds area, so some core bonds where the mix of return for risk is in our favour, and private credit is also a big area we're targeting currently, where you're targeting sort of unlisted loans to both corporate and real estate borrowers, again, where the current returns are very, very strong, and we're not particularly taking any market or spread risk over the short term. We're supplementing that at the moment by some shorter term investments, generally higher quality bonds and a bit of cash, which delivers us our target return. We're not active at the moment in what we might call high yield bonds or the riskier areas of the bond market, convertible bonds, distressed debt, none of those areas we've got any positions at the moment. So we're very much targeting that kind of core minimal market risk part of the segments of the fixed income sphere. In terms of how we construct the portfolio for this fund, Greg's going to talk you through in a minute how that looks right now. But essentially what we do is we find as many great managers as we can. We are agnostic as to where we invest, so we can invest in unlisted wholesale funds, retail funds, listed and directly. At the moment, the portfolio is predominantly in unlisted managed funds, supplemented with a few ASX-listed investments. We would expect that over time we'll also have some direct holdings, and we'll expand those over time as the fund grows. So we're finding all of our best ideas from across that universe, and then we're overlaying a few things to come up with a final portfolio. And some of the things that are important to us, obviously I've already talked about diversification, that's key. Secondly, duration, or how long on average the interest rate is fixed for. And at the moment that's about somewhere between 6 and 9 months. So if interest rates were to go up or down next week, then it would take perhaps on average 6 to 9 months for the portfolio to change. We're also got minimal market risk at the moment, and we've got quite a bit of liquidity. So those are probably 4 key factors that we look at quite strongly when we look to put the portfolio together. How we add value specifically. So I guess a few things. Firstly, we have been investing in fixed income for quite some time, mostly through the Affluence Income Investment Trust. So we've been investing in fixed income through there since we started the fund in 2014, 2015. We spent about 18 months doing a deep dive on the entire fixed income sector and looking at a whole range of managers to come up with our preferred manager set. And we also had some experience in operating fixed income funds back in the early to mid 2000s. I was involved in managing a few mortgage funds back then. So we've had a long time, both as an investor and as a borrower as well, understanding this space and how it works. We've got quite a wide degree of experience. Obviously, we choose the managers that we invest with, and so that's our choice. What we're looking for really is institutional quality managers who are risk aware, who understand what they're doing, and who are able to maximize any recoveries if they have any unexpected issues. Fixed income is all about risk management. It's all about knowing how to react well if the inevitable something you don't expect goes wrong, and being able to still extract the return out of that in that case. Obviously, maximum flexibility is important to us. It's very rare in this space, and we see it as a big advantage to be able to change the composition of the portfolio. Liquidity management, hugely important. It's quite easy to find at the moment a lot of good private credit investments, for example, but a lot of them come with maybe 1, 2, 3 year lockup periods where you're effectively tied into an investment for a longish period of time. And if market conditions change, that very much limits your ability to get out of those investments and reposition the portfolio. So probably the single thing we spent the most time on in constructing the current portfolio is getting the right blend of liquidity and flexibility into the portfolio. I mentioned discount capture. Our ability to come in after an asset, a debt, a loan, or a whole sector has been beaten up a bit, and to take a position and perhaps earn some extra profits as those areas recover is something we've done consistently well across real estate and across LICs, and to an extent across fixed income in the last few years. It's one of our core strengths, and it's one of the things we can probably offer that not many other managers can. And finally, and obviously, yes, we want to deliver regular income, but regular income hopefully with that relatively low risk profile. So we're trying to cherry pick the best opportunities where we think the income is good, the returns will be good, but we're not taking a particularly high amount of risk to achieve. Now I'll pass over to Greg to talk you through the portfolio in a bit more detail.
So one of our main aims for this portfolio is to be as diversified as possible. Now, this gives an example of all the different sectors we're currently exposed to. We wouldn't expect this to change much month to month, but over time, I would definitely expect there will be changes as we see better risk-adjusted opportunities in different sectors. Real estate debt is simply loans fixed against land, buildings and developments. There's quite a lot of providers out there. We think we've picked some of the best, and some of the exposure we've got, the number of types of exposures we have is very large. RMBS, ABS, and other securitized are all into the securitized markets. Corporate debt is simply loans lent to businesses, whether they be private equity, acquisition finance, or refinances for general purposes. Debtor finances is invoice and payment receivables. And at the moment, we have quite a small allocation to government bonds and to corporate bonds being similar to corporate debt, but in the listed traded markets. But again, over time, we expect that will fluctuate as we see opportunities. Currently, we have 10 managers in the portfolio. We've built this up since we started in August. This month, we would expect probably to add another 2 to 3 new unlisted investments. And we have another 3 to 5 we would expect again in the next few months. So I don't think it'll be too long until we're diversified across more than 15 managers. Here's an example of one of the real estate debt managers we have in our portfolio. So Merrick's Capital Partners Fund, it's about 1.3 billion. We've held it in the Affluence Investment Fund since about 2020. It's performed very well. There's been no losses in the portfolio to date, and it's quite unique in two things. First, it has quite a large agricultural lending component. This is very unique. They have sort of specialized in this and kind of made it their own. It's one of the sectors the banks have really pulled back from, and so they get some excellent risk-adjusted returns in that area. And the other is they do a hedging part where they hedge against some CDSs, credit default swaps, which means in a credit crisis, in a market dislocation, they actually pick up returns and benefit from any difficulties in the market. Oceania is quite an interesting one. This is invoice financing. Again, more than $1 billion fund. It's actually backed by one of the largest alternative asset managers in the world. So 70% of this is the invoice financing, which the example is below. So pretty much it's when a client supplies, in this example, bananas to one of the major supermarkets, rather than waiting 30, 60 days to get paid, Oceania will pay them the majority of the invoice upfront. They are secured against the invoice. Their creditor is essentially Woolworths. And so it's very low credit risk and quite repeat business, and it's very, very low arrears. We also securitize these. The notes were in the A notes, which is very protected from any credit losses. And we also have a little bit of B notes, giving a very attractive return of 8.9% blended. And the last example we'll give is more of a typical private credit fund in the Revolution. Revolution is, they have three components they look in, being asset-backed securities, which is the securitization market, leveraged buyouts, which is loans to private equity providers when they buy a new business, and real estate debt. Now, they have increasing the real estate debt recently as they see more interesting opportunities, but this is one of the best managers in the sector. The main portfolio manager has been in this sector for a long time. He's one of the pioneers in Australia, and we are very happy to have this manager in our fund. This is an example of why we don't currently hold any traded debt or debt that's exposed to market moves and mark-to-market movements. So this is a graph of the margin for high yield debt in America. The gray bars are recessions, and it shows what happens to the margin or the credit spreads when markets become dislocated. So for example, if margins blow out 5% and you have an average 5-year term on your debt, you can very quickly lose 25% of the value of your loan instrument very quickly. Now, rarely is it fatal, rarely does normally recover, but in these periods when markets do become dislocated, it's an excellent opportunity to take on some market risk, and you can get outsized returns. And another similar example, but a little bit different, is the debt LITs. We've done this quite a few times in our Affluence LIC fund and Affluence Affluence Investment Fund. So this example is QRI. The yellow line is actually the NTA. So the NTA, through all these crises, they haven't had any losses. They paid their monthly income every month and the NTA never fell. However, some investors very quickly lost 15, 20% of their traded value, mostly due to panic and concern. But we took this opportunities to buy quite a lot of these and the others during this period and then sell at par when they recover. So this won't be something that we can do all the time, but there will certainly be instances where we can add value this way.
Thanks very much, Craig. So that gives you some insights, I think, into what's in the portfolio now and just as importantly, what's not in the portfolio and why, and when we might look at putting that stuff in there. I think when you're looking at this fund and comparing it to other funds in the sector, these are some of the important things to take into account. So not all fixed income funds are created equal. There's really a massive array of risk and reward within this sector. What we're trying to do is lower risk through diversification and flexibility, through investing across a whole range of different subsectors, different managers, and different ways of doing things, different investment styles. Whereas most funds in the sector, you will see one or perhaps more, or perhaps in some cases many of these risks, particularly within the retail fund space. So a lot of funds available to retail investors. There's some very, very good ones, some in fact in our portfolio, but there's some others where the quality is not great at all. And there's a lot of kind of hidden risks in that part of the sector. So I think what we're trying to do is take away a lot of the single manager, concentrated portfolio, development risk, subordinated loans, all these things which can, on the surface, provide higher returns, but underneath is perhaps some underappreciated risk that goes with it. And so we're looking to treat that risk as much as we can by both diversification, but also by choosing those managers where we have a very, very high confidence that through the cycle, they're going to do an exceptional job of managing what it is they specialise in. Just to summarise then, this is the key terms of the fund. So for those of you who are familiar with our funds and who've seen other affluence funds, very similar. The service providers are the same. Perpetual is our custodian, Registered Directors our registry, and Pitcher Partners is our auditor. The way you come in and out of the fund is also the same. So we have monthly applications. The cutoff will be the 25th of each month. So if you apply by the 25th, you will get issued units effectively on the first day of the next month, and your returns will start accruing from then. If you were to withdraw from the fund, again, the cutoff's the 25th, and we tend to pay out that withdrawal on the 10th of the next month. Distributions are paid monthly, about 10 days after the end of the month. You can reinvest your distributions if you wish. We are suggesting an investment timeframe of at least 1 year. Even though we consider the fund to be at the lower end of the risk spectrum, we still want time to make sure we can do our work and that any unexpected events get catered for. So minimum 1 year period. As with all our funds, no fixed management fee. Obviously, the underlying managers do get paid. We do quite a good job of vetting those, and the overall fee load at that underlying manager level is very much in line with what you would expect to pay as a wholesale investor. What we get paid is 10% of the positive performance of the fund, so a performance fee only. That's actually the lowest fee of all of our funds. Normally it's 12.5%. So that 10% reflects the fact that we are in that fixed income space with perhaps a more predictable return, and we're prepared to accept a lower performance fee on that basis. And the administration costs, we cap those at 0.25% per annum, so that in the early months of the fund, it's not getting overly loaded with higher than usual costs. We bear the difference. The buy-sell spread, or the cost of going in and out of the fund, akin to a brokerage if you were buying a share, is 0.1% in and 0.1% out. So that's really the core of what we wanted to talk to you about today. So just to summarise, regular income, the current distribution rate is 7.5% per annum. We are targeting the RBA Cash Rate plus 3% per annum. Multi-layered diversification, So obviously you're getting access to a whole range of very good, in our view, very good exceptional managers, a different range of subsectors within fixed income, a whole array of different investment strategies, and that helps enormously to make sure we can deliver more consistent returns. A lot of the managers we are using are wholesale only, so it would be quite difficult for most investors to be able to replicate that portfolio given the sheer number of managers and in some cases the very high minimum investments that they command. Flexible investment mandate is one of the key ways we can add value, particularly in times of volatility and when markets are changing. And obviously that allows us to take advantage of opportunities, most particularly by taking advantage of either public markets or listed markets to be able to buy debt instruments at a discount to their net asset value in times of trouble, and to then profit as they recover over time to be able to generate perhaps some additional income from that. And finally, like all our funds, we believe our interests are aligned with our investors. We co-invest. We were the first investors in the fund. Affluence Funds Management also holds a stake in this fund. We obviously only charge a performance fee, and we will close the fund if we feel we're reaching capacity, though with this fund, given it's in the fixed income space, capacity is not going to be an issue, I don't think, for some time. So that's a quick snapshot of the fund and how it works. In green at the bottom there is a bit of a description from the target market determination as to who we think the fund is suitable for, and that's important for us if you're trying to get your head around how does this fund fit within my investment kind of portfolio. These are the features we think will, if you're looking for these sorts of features, then this is definitely a fund you should be looking at. Finally, if you want to know more, absolutely, you can give us a call. There is heaps of information on our website on both this fund and all of our other funds. You can give us a call or email us directly if you have any questions. If you'd like to invest, again, you can invest directly from our website by going to the Invest Now page. You can either invest online or download and fill in the appropriate form. The minimum investment is $20,000. We will relax that if someone's looking to invest a smaller amount now, but perhaps to get to $20,000 over time. And once you've got an investment with us, then you can top that up from $1,000 a month. I mentioned the 25th of the month for applications and withdrawals. Probably best to get your money in a few days before then, just to make sure you've covered off everything you need to, particularly for the first investment. And if you're not ready to invest yet, you're more than welcome to subscribe to our monthly newsletter. We'll send out fund summaries and other information that we think might be useful to investors. So we would encourage anyone who hasn't already to subscribe as a way of keeping in touch and keeping it up to date with what we're up to. That's all we have to say from both Greg and I. Thank you very much for your time.
Thank you.
And we'll see you again soon.